So I'm going to start diving in because we are trying to wrap this up before tip off as much as we possibly can. So I'll get started. I have some housekeeping notes I wanted to share with everyone. For starters, I've never hosted on Zoom before, so I'm going to ask for your grace and patience on that already.
How did you make it through COVID without?
I just muted you, Alexis. Like, this is how rookie I am at this. All right. But yeah, never hosted. So we tried a little dry run. And when we did that, my chat box was not visible when I went in to present the PowerPoint. So if you guys send something through the chat, then just know at the end of the PowerPoint, I'll have a time that we can address those questions. But if you wanted to jump in with something urgent and topical, then just feel free to unmute yourself and we can address it at that time. And then finally, we are recording to be hosted later. So if you wanted to text me offline and have me respond offline, that'd be great. And if you wanted to turn off your camera and know that this is being hosted later, then I want to extend that courtesy to you all to know that we are going to host this on YouTube. And go ahead and mute yourselves or turn off your cameras now if you'd like. I have put together a PowerPoint, which I'll share with you all now, and that should get us started and keep us on task and moving pretty well. So hopefully you all can see my screen. Go ahead and nod your head, Jason and Alexis, if we got it. Cool. Awesome. I appreciate it. So this is buying when selling for a homeowner. This is your guide to moving just once. And I've got an overview here about tonight's agenda. We'll have introductions. Myself, it says Terry Porter, but that's not true. We know that. I'm Scott Perryman, and Terry's the only person at TPG with a Zoom Pro account, thus the Terry Porter moniker underneath. We'll talk about the problems that we're trying to solve as a homeowner who only wants to move once. We're going to offer 4 solutions and then very briefly mention a couple others. We'll talk about the pros and cons to those solutions, a step-by-step guide on how you can make this happen. Again, open it up for questions and then close tonight's Zoom webinar. Thank you all for joining me. I do appreciate it, and it means a lot that you're here. So introductions, my name is Scott Perryman. I am an affiliate broker for the Porter Group. I hold an ABR designation, which is an accredited buyer rep. I also hold a RENE, Real Estate Negotiation Expert certification. Those 2 things mean that I've got extra training that is not required to be licensed, but extra training in those fields to become certified and so on. And then I am a member locally of the MMDC. That's the Multi-Million-Dollar Club, which would be really cool if that meant I had a multi-millions of dollars, but that's not it. It just means that I've sold multi-millions of dollars of real estate and paid somebody that money so I could have some alphabet soup. Alexis AHeinz with Patriot Bank Mortgage and does a lot of business with me. I really appreciate everything she does for my clients and so on. She's joined us to provide a little bit of insight on specifically 2 of the solutions, but maybe some more context from the lending side of things. Alexis, if you could just introduce yourself really quickly, that'd be awesome.
Sure. Alexis AHeinz. I'm with Patriot Bank Mortgage. I am a senior loan originator. I've been doing it for a little over 5 years now. And we just, we do a lot of the residential side of things, obviously, but we can do home equity lines and construction loans and things of that nature.
Awesome. Thank you. Appreciate you being here.
Sure.
So why are we here? The problems that we're trying to solve. You are a homeowner that currently lives in a home that no longer suits their long-term housing needs. And whenever I hear that's the case, most people give me something like, yeah, but where am I going to go? And they're afraid of what inventory is out there. So we're going to discuss ways of getting around that. Secondly, moving is exhausting to even think about and contemplate. And so the thought of moving twice to most homeowners is just simply unacceptable. So we're going to talk about how we can make it happen and move only once. So we all know it's a competitive, hot real estate market. Things are selling for over asking, and the traditional methods to purchase and sell at the same time are not as successful as they were in the past. And maybe things will turn around and we won't have to be quite as aggressive on the buy side of things. But in the meantime, let's talk about solutions in a quick and heavy real estate market. Finally, rental rates are rising even more rapidly than home prices in some areas. And as someone who has owned a home, I know that you're not interested in potentially doing something short term, moving into a 6-month or a 1-year's lease and wasting a lot of that rent money on a home that you don't own, especially when they're going to probably charge you more than your current home costs. So those are the problems that we're trying to solve. And we're here to help. Here's some solutions. We're going to go to detail on these 4. Traditional home sale contingency, some of you might be familiar with. We're going to talk about a sale and a leaseback. We'll also talk about a bridge loan. Alexis is going to help us with that. And she's also going to help us with a purchase and recast. And I don't know if you guys can throw a thumbs up or anything like that, but hopefully these are familiar and some of them new as well. And before we move into what those things are, I did want to mention that some additional solutions to this dynamic that are similar, but not exactly the same thing. You could execute a lease on your current house. That would allow you to remove your current home's mortgage payment from your debt to income ratio. You could sell it to an investor, which would be kind of similar to a sale and leaseback, but we'd be talking about a long-term thing where that investor doesn't really care who lives in that house and how long they're there, as long as that rent is paid on time. You could do a home equity line of credit to purchase your next home, which would be similar to a bridge loan, but more long-term. So bridge loans are meant to be a short-term solution. And Alexis will kind of elaborate on that a little bit. And a 401k loan, or like a self-directed IRA, using your retirement accounts and telling those retirement accounts how to purchase real estate on your behalf. Those are some other solutions that would allow you to purchase your next home and then move into a more permanent place and execute that move just one time. But for tonight, we're going to go to detail on the first 4 bullet points, and we'll start with the home sale contingency. So what is a home sale contingency? So a buyer offers to purchase a house as long as they can sell their current home. And the way in which you would execute this would be special stipulations to your offer. Other states will call this additional provisions or something like that. But you make an offer to a seller that reads like this. This agreement is contingent upon the sale and closing of the property located at 123 Main Street on or before the closing of this agreement. If the property does not close on time, the buyer may elect to terminate. That word may is important, and we'll touch on that a little bit later. They may elect to terminate this agreement and get a return of their earnest money. So you want to buy a house, but you have to sell yours first. And so you write this language into the special stipulations or additional provisions, and the seller knows that, yes, you're offering to buy their house, but only if you can sell yours as well. So if that doesn't happen, then the agreement was always contingent upon that happening. and the earnest money is returned to the buyer if they're unable to close due to their home not selling and closing prior to the contract to purchase their next place. So hopefully that makes sense as to how you can move from one home to another and only move one time, because obviously you still own your home. So this is a very buyer-friendly solution. By that I mean the seller accepts and recognizes that if you don't sell, they don't sell. So that is a tough thing to get accepted right now in our market. It's not impossible, so don't hear that it's impossible. And that's why we're talking about it tonight, is because they know the inventory for your home is extremely light. And so sometimes they are willing to accept a home sale contingency if you have the other goods. So let's move on, unless we have any questions, to solution number 2. I'll give that just a second if y'all wanted to unmute yourselves and ask any questions about a home sale contingency. Okay. Solution 2 is a sale and leaseback. All right, so in this dynamic, you're going to actually sell your home to a buyer, and you're going to execute a temporary leaseback from the person who purchased your home for up to 60 days. And that up to 60 days is important because, Alexis, you can correct me if I'm wrong, but I think that a lot of the loan terms and the homeowner's insurance that a lender is going to require are going to state that the owner will occupy that home within 60 days. Otherwise, the terms of the loan and type of insurance would be different. Is that about right?
Right. Basically, they require that you have to be living in that home within 60 days. So if this is on the contract, then that 60 is the highest number that can be.
Okay. And so there's a forms committee made of attorneys, title companies, realtors, and they have created the Tennessee Association of Realtors forms. And so they've put together this temporary occupancy agreement for seller after closing. All right. And so that's how you would execute a sale and leaseback, is that you would make this form an addendum to your purchase offer. And so you can see, maybe you can't, it might be really small, but on line 11, it says this form is not to be used for occupancy more than 60 days. And so the forms committee, knowing what most lenders require and a homeowner's insurance and all those other things that are involved when someone else lives in another person's home, you know, we're wise enough to say, use a different form, execute a long-term lease if you're going to occupy this home for more than 60 days. So that's a pretty scary situation, right? You would be selling your home to someone else and then occupying a home that you used to own while you look for another property. So this sale and leaseback solution, want to make the point, definitely that's going to put pressure on your timeline to purchase. And that's going to require a plan B in case you're not able to find a new home for purchase. So there are different circumstances that might lead one to go this route. If you can sell your current home, then that mortgage payment is no longer counted against your debt to income. You might have very limited equity in your current home, and therefore you need every penny of it in order to be able to purchase the next place. So those are just a couple of situations in which the sale and leaseback might be appropriate for your given situation. But make no mistake, that puts a lot of pressure on buying your next home with that limited timeline. And so whereas the home sale contingency is very buyer friendly, in that the seller recognizes that you have a home to sell first. In this sale and leaseback dynamic, that doesn't involve the seller, obviously, because you don't have anything to sell and you're performing as though you're buying maybe your first home even. Questions about the sale and leaseback solution? Going once, going twice. All right, let's talk solution.
I have a question.
Go ahead.
Is that similar to a ribbon loan?
It's not.
Okay.
Ribbon is a kind of a complicated solution whereby buyers are able to operate with like cash. They can do that in a number of different ways. But basically, Ribbon is a company that started in the very aggressive real estate market that we're in, and buyers kept losing to cash. And so they came up with a solution where on paper, a normal home buyer could present themselves as a cash buyer. But no, it's not a sale and leaseback dynamic. And
Okay.
we can talk more about that if Ribbon sounds like it might be a solution for you.
Okay.
So solution 3 is the bridge loan. Alexis is going to jump in here and help me with this because I don't love the way this is worded, but it says that you can use 90% of your current home's equity as down payment on the new home. So you can do this before selling. That much is true. And we've got a scenario here where this is a great solution for someone who needs to buy their next home, but a lot of their assets are the equity they have in their current home. And so that 90% of your home's equity is not exactly accurate. And Alexis, I'm going to let you jump in and take it from here to tell us what is a bridge loan and how does that work?
So basically, we came up with it. We're a mortgage company that also has a bank to go with it. So we're Patriot Bank Mortgage. The benefit of that is that it gives us flexibility that a lot of lenders don't have because we can pull essentially some of the money out of our bank to help people get into homes. And so one of the things that we've come up with is what's called a bridge loan, which essentially helps you to bridge that gap. Most people's equity is tied up in the home that they currently own. So they a lot of times need to tap into that equity to be able to pull that cash in order to purchase a new home. So the scenario we did was just a very simple one to understand. If your current home is worth $100,000, so let's just say it'll appraise for $100,000, you owe $40,000. Well, of that $100,000, we can loan you up to 90% of that, which simply put is $90,000. We subtract out what you owe, which is $40,000, and so that means that there's a roughly $50,000 of equity there. Now, there's a few closing costs here and there, but let's just say you've got $47,000 to use. That now can become down payment. It can help with closing costs, prepaids, whatever you need it to do on the new home. Now, there are some, and I think Scott's going to put the points up there for us, but there are some requirements for it. You're essentially looking at 3 mortgages that you have to be able to qualify for. You've got the new mortgage on the house that you want to purchase. You've got the current mortgage on the house that you own. And now you've got this new equity line mortgage. So people who, have low debt to incomes, this is a great program for them. But we can also be somewhat creative on those if we have to be. That equity line, that bridge loan is just an equity line. So you're only paying interest only on it. So it's a fairly small mortgage as well.
Yeah, so the bridge loan has been a great solution in the past couple of years, especially because people have seen a lot of appreciation in their homes. And so that's where a lot of their wealth is in that appreciation. And so this is a means for those buyers to be able to tap into that equity without selling. Now, you do get a temporary loan, like it's kind of like a home equity line of credit, but you're only paying interest only to be able to access that equity. And so that's been a great solution for a lot of people in the move up buyer situation. So that we bought a house 3 years ago, it's appreciated out the ceiling, and now I can use that $100,000 of appreciation as an example to then roll that into the more permanent 10 to 15 year home as my family has grown and things of that nature. So I like the bridge loan. It has limitations though, in that you must qualify for all 3 of those mortgage payments. And it is a little more expensive because you do have to pay for the bridge loan to be originated as well. So in terms of solutions, we've talked about a home sale contingency involves the seller. They accept that you must sell first. In a sale and a leaseback, well, you've already sold your home, so that doesn't involve the seller of the home you'd like to purchase. And in this case as well, you have a financial contingency most of the time when you're going to go purchase a home. And so it doesn't make any difference to the seller whether you qualify for the mortgage to purchase their home, or in this all three dynamic, your current home, their home, and the bridge loan. It really doesn't involve them at all how you're able to perform with that. Just the pre-qualification and pre-approval that you would have from your lender is all that they need to know about your ability to perform on the offer you're making. They don't need to know that you're also tapping into your home's equity, in a nutshell. So that's a pretty tough one and a new one, I'm sure, for a lot of people. So if we have questions, I'd welcome those real quick before we move on to solution 4.
Yeah, Scott, I got a question. How do like as it currently stands, how do rates on bridge loans compare to like a home equity line of credit? Are they, and how, what is the typical term of a bridge loan?
So the bridge loan it's essentially an equity line. So your rate is going to be, most banks are prime +1, and whatever that may run. So it's going to be very, almost for us, it's identical to an equity line. We've got a little bit of flexibility, I guess, with, like if someone's doing permanent financing with me, then I can do a little bit better for them on the equity line, because it is going to be a quick temporary fix to it. But let's just say you get stuck with that house for a while. We set these up ideally, to be done within a year. But we can also extend it if we need to, as an equity line would be a 17-year repayment thing. The first 7 years are interest only. After that, it amortizes as far as a 20-year mortgage payment to pay off in 10.
Okay.
So, yeah.
Okay, thank you.
Yeah.
Awesome, thank you. So solution 4, guys, is the purchase and recast dynamic. So whereas the bridge loan would require that you qualify for all 3 mortgages, in this purchase and recast situation, you might have a little bit of cash that allows you to purchase that next home. So that's what you would do. You would purchase that next home because you don't want the cost of the bridge loan, and you can afford 2 mortgages, but not 3. Maybe there could be a couple scenarios here. So you're going to purchase that next home as normal, as though it was the only home that you owned. And then once your current home sells, you're going to use those proceeds from that sell in order to pay down the principal on your new loan. And then you're going to recast the remaining balance of your new loan over the life of the loan, which is going to reduce your monthly payment. So here is the scenario that we've set up, and Alexis is going to correct me on everything I just said wrong and talk about the purchased and recast dynamic.
It's a program that most mortgage companies offer. They just may not know it or know how to present it. But basically, if your cash is not tied up, you've got 5% maybe, or whatever you can to get into the new house, and then you sell your house, and all of a sudden you have a ton of equity. Like Scott said, you can put as much equity as you want onto that new, the principal amount of the new mortgage. It's going to keep your interest rate the same. It's going to keep your loan term the same. It's not like a refinance where you either start over, you have all those closing costs, or maybe you decide to go from a 30-year to a 15-year. With a recast, if you've paid 3 months worth, then your loan term is going to be 357 months remaining. Interest rate stays the same, and typically the most out of pocket is $250 to do a recast.
So break that down as far as why you might consider this option, $300,000 purchase that we've got.
Right. If
Don't
you
say
look
you
at the
wouldn't.
scenario,
You're not allowed to say
go
you
ahead.
wouldn't consider it. Don't consider it.
We've actually done this before. It's been great. I mean, we had to, whatever reason, we were able to put money down on our principal and reduce our monthly mortgage. But let's just say the purchase is $300,000. And if you look at the example here, you've got $25,000 out of pocket that you can use as a down payment. So that gets you into the house. And then after selling, you've been able to put another $100,000 down straight on principal. And you can see the difference in what it does on specifically that principal and interest, that monthly payment there. So in my opinion, the best thing about a recast is that there are, for the most part, no out-of-pocket cost for you. You're not turning around and paying $6,000 to $7,000 in closing costs to do it, but yet it's able to reduce that monthly note pretty significantly. Most mortgage companies allow you to do it more than once, as long as you have, 10% to put of the loan amount to put down. So you can do this periodically throughout the life of your loan, as certain things happen. I have a friend of mine that did it because they had a parent unfortunately die, but they came into a lot of money that they will just recasted onto their mortgage. So there's different reasons why this would become a good thing for you.
Cool. So versus the bridge loan, reduced loan expenses, because we're
Right.
not issuing and originating a home equity line on your current. And so you reduce your loan expenses on the front end, and maybe from a debt to income perspective, it's easier to qualify for your current, which you refinanced in 2020 to a 2.5% interest rate, and this purchase, right? And so it's just easier to qualify for those two loans than it would be to qualify for all three. So that's why you might consider this option. Or yeah, I've heard it many times where somebody's coming to some money or a bonus, and this is how they'd like to spend it, is to reduce their monthly expenses on the mortgage. And so, yeah, in the scenario that we've described, you pay cash out of pocket for like a 95% loan. And then once you sell, you've got the proceeds from your current home to pay down that principal, lock in a smaller payment for the remaining life of your new mortgage. Again, in this situation, as long as you can qualify for both loans, it doesn't really matter to the seller how you do this. And so from like a competitive perspective, this would be better than a home sale contingency. So that's what we're going to jump into now is pros and cons for these different solutions. So for the home sale contingency, a pro to me is that you have greater flexibility with the offer that you can accept when you're selling your home, because it's kind of step one and then step two. And that might make more sense as we talk about the other solutions and some of the cons with them maybe. But with a home sale contingency, you do have that flexibility as to who can buy your home. You have more certainty around the proceeds you're going to net from selling. So from a bridge loan perspective, you're not really sure exactly how much your home is going to sell for, right? And so the proceeds that you're going to net from that sell are a little bit of an unknown, whereas when your home is actually under contract with a definite close date, then you can pretty well figure what kind of proceeds you're going to be able to use in purchasing your next home. So that's another pro of the home sale contingency. Very limited risk of paying two mortgages. If you'll recall, when we talked about the language and the special stipulations, it reads that if you're not able to sell and close on your current home, you may elect to terminate. You could, at the same time, assuming you're able to buy both homes, you could remove the home sale contingency because it didn't sell on time and the sellers are tired of waiting. Okay, but you go into that kind of eyes wide open. And so the risk of having two homes is very limited in the home sale contingency situation. Cons, we've talked about how it's not quite as attractive to sellers. Their futures become very closely tied to your ability to sell your home. and therefore they're not as apt to want to engage in that agreement. I've seen this. I call it just a rush job. I was actually in a house yesterday where I felt like what had happened. They listed the home, yesterday was a Monday, right? And they put it on the market that Monday, and there was still some paint and some cleaning and some things that just seemed to me like, all right, if we're going to create a narrative so Scott can put this to bed and sleep tonight, they bought a home this weekend and now they got to get theirs on the market to make this happen. And so it wasn't quite ready, and they weren't putting their best foot forward when they entered onto the market. And that's really common when people have a home sale contingency. I'll see them put one photo on the MLS and just say, y'all come and get it, right? And that's not the best way to present your home to the initial buyers who are really excited to see it. And then another con of the home sale contingency is you might lose the one if your home sits. This happened in 2020 when home sales contingencies were still more common. When they shut down everything, I had two clients actually who were under contract, and then just that weird limbo period where nobody knew what was going to happen for 2 or 3 weeks. Well, their home sat on the market, and therefore they had to terminate the purchase of the home of their dreams, just because everybody was unsure and their home sat. So it could result in that, which is a con in terms of buying when selling. Moving on to the sale and leaseback. Pros here. So you have certainty on your shopping budget, right? Because your home is already sold. That cash is liquefied and you are ready to go buy another one. You have no risk of paying 2 mortgages, right? You've already sold your house. You can shop with no contingency on selling. So versus contingencies being a little bit harder to be accepted by sellers, in this case, you can shop with no contingency. And then your current mortgage is eliminated from your debt ratio. So with the bridge loan and a purchase and recast dynamic, how much you owe on your current house on a monthly perspective limits the amount you're able to finance on the next purchase. So sometimes this could be a solution for you and a reason to choose it. Cons, so limited options on the kind of buyer who can accommodate a post-close possession. So that's going to hold a lot more value to you as a seller if someone can accommodate your situation, which means that you may have to leave money on the table because the person who can give you the best offer financially can't wait 60 days. So that's a con. Living in a home that you no longer own just feels icky, and I don't like that. And so living in a home you no longer own, I would say is a con for sure. And it's going to require a plan B. We talked about that when we presented this as a solution. What happens if you don't find a suitable home in the next 60 days? Which can also increase the pressure on your shopping experience. You might settle because you really don't want to move into that apartment for 6 months. One thing I wanted to mention as far as a home sale contingency, another dynamic that you could consider if you were going to list your home before buying your next place and knowing where you're going. I've seen people actually work in a suitable housing contingency in which a buyer makes an offer to buy your home, but you tell them it's contingent upon your ability to go find another home before you agree to sell. So that's kind of an inverse home sale contingency. It could be a home purchase contingency. And as we're talking through these things and recording this, I felt like maybe that was a good time to mention that as a possible solution as well. So you don't have to sell your home and get out in 60 days. Bridge loan, pros and cons. Pros, you can list your home once it's ready for the market. You qualify for all 3 of these loans, and you don't have to execute this game plan until you found where you're going. So that's a pro. You have complete flexibility on the offer that you can accept. So you don't need a situation that works for you. And that's a pro. Shopping with no contingency upon selling. And then again, you can wait until you find a home before you execute this. And that's a pro. So that you're not settling like you might if you had a 60-day drop dead kind of situation. Cons, your current mortgage and the bridge loan count against your debt ratio. So you may not be able to afford as much of a move up home as you would if your current home was already sold. You're going to have increased closing costs because you're getting multiple loans. We talked about that. And here's a possibility of paying 3 mortgages. The reason I say that this is a possibility is because anytime that you purchase a home and set up escrow, that is, your first mortgage payment won't be due until you skip a month. So today is the 26th of April. Your first mortgage payment on your new home, if you close today, would not be due on May 1st. It would be due on June 1st. So the possibility of paying on the bridge loan and your new home and your current home is kind of mitigated by the fact that you could close on this home today. Your home went on the market last week and it's under contract to close in May. And now we don't have 3 payments on May 1st, right? We're going to close on our current home in May and then start on our new loan in June. So that's why I say it's a possibility of paying 3 mortgages. You could really time that well and get out of it pretty normally, pretty minimally. However, it is a con to have that pressure and possibility of 3 mortgages, and that could increase your feelings of needing to sell quickly in order to avoid 3 mortgage payments. We're going to talk about pros and cons of a purchase and recast. So pros, kind of the same as the bridge loan. List your home once it's ready for the market. You can work with whomever because you don't need a situation that matches yours. You can shop with no contingency on selling, and you can move comfortably. You know, if you can afford to buy that next home using your cash, then you can list your home whenever it's good and ready, right? Cons, you just bought a new house. You're going to need new furniture. You're probably going to want to paint it and some stuff, and you just depleted all your cash reserves. I think that's a heavy con to the purchase and recast situation. Alexis, jump in here if this is wrong. We talked about this, but in a purchase and recast situation, there is a chance, I think, that you could have a higher interest rate due to less money down. Go ahead.
Not really. In fact, like the interest rate, I mean, it's 5% down and 10% down is going to be pretty close. 20% is typically the worst pricing of the rate, but we don't usually punish you for putting 20% down.
So if it was 40% down, would that have a better interest rate than a 5% down?
Sure.
All right, that's why we got that bullet point in there. So if you got a ton of equity in your current house and you have very limited cash currently, you could go buy that place at 5% down. All those proceeds from selling your house come to you, and now you've got like a 60% loan to value. Well, that would probably have gotten you a better interest rate than you did when you purchased it because you had limited cash. So in this situation, there is the possibility of paying 2 mortgages. We talked about how you could be able to time this thing such that your current home is paid off prior to the new mortgage starting. And this little bullet point here. So I know that some loan services are going to require that you have your current loan and terms, and you pay on that for 6 months prior to allowing you to execute this recast. Is that from like a mortgage insurance perspective, or what might be the reasons for that, Alexis?
It depends honestly on it's individual by investor. Some of them want you to make 3 mortgage payments for 90 days before they let you recast. A lot of it is in reality just letting them get your mortgage actually set up with their company and squared away.
Interesting.
So,
okay.
Yeah, but in some cases it's just one payment that you have to make.
Okay. So there you go. It might require kind of some elevated holding cost until your loan servicer allows you to execute this recast. So that's a potential con of the purchase and recast.
And And to go with what you're saying, and I won't take long on that, but sometimes waiting 6 months, if you've got mortgage insurance on it, that's going to be a case by case basis too. So the longer you wait to recast, you might can get rid of that mortgage insurance immediately. So it's a good point.
All right, so what do we do? We've talked about 4 solutions here, and I think the first step is just to assess your finances. I would get in touch with a loan officer and figure out what can I qualify for based on my current mortgage, based on what kind of cash I have, and my debt to income ratio. So assess your finances is step 1. And the reason I'm putting that before anything else is that even a conservative estimate on your current home's value is sufficient at this point in the game. So I know I've offered to people, oh, we don't know where we're going and we got to sell our home first. And I've said, all right, we'll talk to Alexis and she can let you know if you might qualify for a bridge loan. And then they'll go have that conversation. And a day or 2 later, as she's processing their application, call me and say, hey, what do you think their home is worth? And I'll shoot low. Like, well, I know we can get 300 for it. So just work with that. And then we can still start to put our game plan together here. So that's step 1. And even a conservative estimate is good. But then number 2, we do want to go ahead and conduct that listing consultation. Okay, so while you're weighing your options on what you can do and how you want to do it, you can begin the process of getting your house market ready. So with the Porter Group, we have the listing consultation in which we say, instead of doing the rush job and needing to clean the house and paint the house and repair a door that has a teenager's fist through it, maybe let's go ahead and conduct that listing consultation. We can start the process of getting our house ready. And then we could also be able to give you a little bit more reliable number on what your home might actually sell for, not just that conservative game planning number, but like, hey, here's what the market says if we make these upgrades and make ready repairs. So step 3 is to start shopping. So at this point, you have a better sense of what you can afford because you've been pre-qualified. You've got an idea of how you want to execute it, whether it is going to be necessary to list your home first. And I think it's important to go ahead and start shopping. Figure out if your current budget and dynamic works to go operate in the marketplace. Do you have the ability to buy the type of home that is a more permanent situation for you? Does your current budget get you the type of home that you want? Make sense? So step 4, go ahead and take photos, even when we're in the midst of shopping here, because unless you're getting into the buying market and you realize there's a mismatch in what we can afford and what we want, then you're ready, right? If you take these photos, you're ready to list your home immediately once you find the right house. And I think it's a good idea to go ahead and take those photos so that even if you're doing a purchase and recast, right, and you're going to move, well, the house is probably going to photograph better when it's got your furniture in it and it's all staged and pretty. So go ahead and take those photos and you'll know as soon as I find out where I'm going, I'm ready to put my house on the market. And so that's step 5 is just execute. And so whatever solution you feel like is best, whatever means you have, this is going to mean purchasing that next home, putting it under contract, or it might mean listing your current home because you really got to sell and lease back from the next guy. So good luck and Godspeed. And that's the step-by-step on how you can execute this only move once dynamic when you're buying and selling at the same time. Questions, please.
I've got a question, another one. And this is probably a dumb question, but I'm new to all this. So if I were to take out a HELOC to, potentially pay a down payment on another home, which is, I think, one of the options. I guess, well, it's kind of related to not selling currently. So if we want to take out a HELOC to purchase a second home or a rental home or something, how does that over the course of that HELOC change if the value of our assessed home goes down? You know what I mean? Like it's at a pretty high point right now, but in 2 to 3 years, who knows how that's going to be? And the length of those loans are what, 30 years, right? They're the length of a mortgage potentially.
HELOCs, the HELOCs are only going to be 17 years typically. But in
Okay.
that 17-year period, you can, refinance it, essentially make it a cash out. You can redo the terms of it, or you can pay it off. And basically, you're going to have to get an appraisal on your house as it is now.
Right.
And that appraisal is going to stick based on that loan.
Gotcha.
Yeah. So,
Okay, so those two are strictly tied together. That's
yeah,
essentially what I was getting at. Thank you.
right. Yeah.
Yeah, so Jason, to your question, yeah, there is that potential that your home could lose value, and now you're over leveraged, right? You have a
Yeah.
loan based on an appraisal that's no longer valid because the market has changed. And that's kind of where we got into a lot of trouble. I don't know if you've heard about it.
When was that? About, I don't know, about 10 years ago or so? 14 at this point?
That's right. That's right. But yeah, that's how that would work. Any other questions? Maybe we'll discuss ribbon at another seminar sometime soon. Well, thank you all for joining us. Not too bad. I think the Grizz tipped off about 10 minutes ago. All right. So I appreciate y'all joining me. I hope it's helpful. And we've got contact information up there if we needed to dive into, hey, Scott, what's my home actually worth? We could take a look at that. And if you did want to get started at step one, Alexis, thank you for your time today and all your insight. You guys can contact her and Patriot at the information there on your screen. Appreciate you guys joining us, and y'all have a good rest of your evening.